You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Jim, here we are, and it's good to be with you.
Bond watchers were up overnight during the week watching the German Bund take a ride and a half.
Oh, yeah. Actually, this one goes back to April 18th, 19th, when, let's just call it insanity, where the European Central Bank was buying the German 10-year note, call it the Bund, and right down to a yield of 0.056 or something like that. Just never ever has happened in financial history. Now, it wasn't just the central bank buying the bond, but there would be guys who get onto the trend and buy it as well. So we go back to late January when we did the study on ending action in the U.S. bond rally, that one. And we also in that study, and then repeated in February and March, was that as the U.S. bond price came down, that it would eventually feed into the European bond market, which then it continued all the way down, let's say, till April the 20th, yields falling. So it started to turn around, and the first day or two, it sort of got like, it did quite a move, and that was technically turning. So then it jumped in yield to 0.6. So it was let's just round the numbers, 0.06 to 0.6. We're talking small numbers, but a very big change, and very dislocating if you were a late buyer, and or if you'd been a central banker who was continuing to buy. So then it surged up to, let's say, 0.8, and then corrected, and then early in the week started to rise again, and then that's when the other day Mario Draghi, head of the ECB, came out and said, oh, watch out for volatility. Well, it had already been horrendously volatile, so that drove it up to almost 1%. There's a lot of blood out there on this one. It's amazing. So when it started to turn in late April, we thought that our mind went back to 1992 when various big traders were working against the different European currencies then traded and making money as they fell, and then they put their attentions to the sterling, which the Bank of England was defending very strongly, and George Soros is reported to stayed with the short trade and kept working at it until eventually the Bank of England broke, and Soros is reported to take $2 billion out of it. So here's the thing that I like about the change in interest rates in Europe is, one, the change is happening, and the other is that the short will be making money out of it, and the longs, being central bankers, will be losing money, and it could turn out to be very heavy duty. So the trend is early in this thing, and the low in interest rate was totally absurd. So I think there's a long ways to go in rising interest rates. Now, this does not mean that long-dated interest rates would rise because of a stronger economy. I think it's just be straight a liquidity problem where the economy in the U.S., some of their macro numbers for the last 3 or 4 months have been dropping down. And this is where we relate to the stock market, is that these weakening numbers, consumer sentiment and housing starts and things like that, could be the start of a cyclical contraction. And but the stock market has been buoyant, making new highs, and we've been saying that this is probably on a seasonal move, and ultimately the two would find harmony, where more than likely they'll both go down together. So we've seen some tremendous successes in the stock markets going into May, which was our target for this year, probable high. I mean, that's easy, that's seasonal. But you also had, Jim, some historical stuff going on in Shanghai and Hong Kong markets with new clients opening up. What was it, 1.5 million clients a week, and new issues. There was this one Entercom or something like that, where it came to notice when it opened up one day down 50% from previous, and the guy who was the principal shareholder, he was briefly the wealthiest guy in China at $40 billion, and then the next day it was dropped down by that. But we thought at the time that when that kind of a crack, that insiders must have been terribly leveraged in the stock, and indeed it was. As a matter of fact, the insiders owned a whole bunch of the stock and had been buying it on the way up, probably squeezing shorts on the way up until, for whatever reason, the magic stopped, and it stopped real hard. So in previous global bull markets, when the action become highly speculative in lesser exchanges, and this is not to say that Shanghai is a lesser exchange, but it's a big one, but it's not the mature exchange such as, say, New York or London. So let's call it an outlier. When they have a problem, it usually feeds back into the mature market. So we can watch for that. And then, of course, today in the stock market, you had an employment number in the U.S. that the folks really liked, but of course that number has been rigged. Something awful anyways, but it's amazing how many in our business accept and trade off that number, but it's phony as can be. So, but anyways, they really liked it. Stock rallied and to the plus side, and then it's giving up on it here. So we live in interesting times.
We'll have more with Bob Hoye right after this.
More and more people are looking to the Internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Margin debt is at a record high in both China and North America. What does that say about the markets and what could happen?
Well, this is the mark of confidence and enthusiasm in the market. You're making money every day, and you amplify your gains by owning more and leveraging it up. And it's an ancient condition, and they're there now. Last year, at about this time, you had a spike up in New York Stock Exchange margin, and then it corrects, and then it traded sideways for a while. But often on that pattern, like in 2007, that after 4 or 5 months from the spike up in margin, then the stock market would begin to decline. But this one, because I think of all the hands-on stuff going on in the bond market, and also we've seen that central banks have been buying equities as well. So this then pushed margin up to yet another spike high, somewhat higher than last year. So whether one would say that you might need 5 months of correction off of the spike in margin before the stock market really rolls over, well, that gets us out to the fall, doesn't it? So we used the old Dow theory beginning in February. Noticed that the transports were not confirming the highs being made by the Dow, and then in reviewing that technical tool way back, we noticed that if the longer the non-confirmation went, the more the stock correction would be. So this one went right on until April when the Dow set a high. And but in the meantime, the transports kept taking out 50-day moving average, then a 200-day, and down to quite a low recently. And then, so we had it that the first step in a decline for the bigger senior indexes in New York would be when the Dow takes out the 50-day moving average, which it did this week and is staying below, although earlier today the market was down a hit, and then it on the employment number took a rally, and it's now on the minus side for the Dow. So it'll be interesting to see how this old technical tool does this time around. I know that when it became more noticeable, say perhaps into March or April, there were the other type of analysts were saying, oh no, it's an old-fashioned thing, won't work. But I don't know, we haven't used it, and I don't ever recall using the Dow theory, but for some reason or other we tried to do it this year, and it's providing some good guidance. So the other one was that we're looking for this year was a rotation whereby some of the beat-up commodities would rally out, say from when they had their bottoms in December, January, out to around May. And as we've been noting, the base metals did well. Base metal mining stocks did well. We had a pretty good couple of rallies out of crude oil, and the XLE, the oil stocks, did okay. But as they were peaking, we advised to take the money off the table, and quite content. I think this is now what we would call a trader's market, and the long-term view is now all bullish. Complacency at records and the margin at records. So this is where one has to look at it as a trader. And what we're looking here now, some late ones like, even iron ore a few weeks ago set a low and has recovered a little, but that thing's been diabolically weak ever since the big high for commodities in 2011. So this is going to plague the markets because weak commodity prices can be part of weak wholesale prices, producer prices, that sort of stuff. And it's an indication that pricing power through a lot of industry is not all that strong. And you have a huge debt out there. Companies have been borrowing money in order to pay dividends and to buy their stock back on the exchange. I mean, that's totally insane, that one. So the things to watch here now are on the credit market side. We've been looking for the typical decline or narrowing of credit spreads into around May. That's a seasonal thing. And on the spread we were watching, it got down to 176 and bumped down there for 4 or 5 weeks. And then last week it had to get above 179 and it hit 183 basis points. So that spread is starting to widen. And also we got the bond market, as I say, in Europe. This I think is where it was the rally of, well, there's been never any other bond rally in history where you had a 10-year note for, well, a solid economic country, Germany, down to a yield less than 0.1%. So that will be interesting. So I think the best is virtually in for the general stock market. The best was in April for global bond market, and now we're looking for widening credit spreads. So we'd be shortening term for investors in high-grade bonds and avoiding low-grade bonds with as best one can, and beginning to lighten up on general equities. This isn't good. Now, this brings us to the precious metals side, and unfortunately, it is still stuck. There's nothing exciting there. It's had participated to a degree in a rotation where the first rally out of December was really good, and it got up to the 200-day moving average, and then set back, and then the next rally, more or less, with various tools we've been using, and getting to that 200-day moving average, and then falling back, and that 200-day moving average continued to decline. So we had, in a big study in November, we're looking for a bottom and advised buying a little on the gold stocks on weakness, and then twice on those rallies up to the 200-day moving average, we advised taking the money off the table. So effectively, we bought a little and made a little and sold a little and are flat on it now. We wouldn't own any gold stocks until something more dramatic happens, and that would be if in the last half of the year the general stock market sells off, and gold stocks won't be doing too well then either.
What about the IMF asking the Fed to hold off on any interest rate hikes until the new year?
Oh, Federal Reserve, central bank, what a lot of nonsense. I'm glad you brought it up, Jim, because we did a review a long time ago that the most exciting times are when you're in bubble worlds. So the previous ones, 1873, 1929, and then 2007, and on those major moves, which are big issues, the central bank was 3 to 4 months behind the changes in market rates of interest. Like, for example, in 1929, and here's the telltale on when a bubble's over, is when interest rates start to go down, because speculative demand for funds slows. So, indicating the next contraction, T-bill rates stopped rising in April 1929, started heading down, and the central bank didn't put its rate down until October. And then similarly at bottoms and tops. So the main thing is that where the street now is fascinated about the next rate increase by the Fed or and whatever, it doesn't matter, because the market rates of interest will have turned before the policymakers turn. So this is, talk about waste time and waste energy discussing about whether the Fed's going to raise or lower interest rates. Absolute nonsense when you're in a bubble world. So don't pay any attention to it other than to condemn it. And we're looking at here now, this Dow's weakening just since we've been talking in the show. So not a healthy market anywhere. And let's leave her at that.
Okay, Bob. Have a great weekend.
You too. We've got good weather this weekend, and we'll be out enjoying it. What about yourself?
Why not?
There you are.
Thanks a lot again.
Pleasure.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. His website, institutionaladvisors.com. You're listening to HowStreet.com Radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.